Welcome, everyone. Today, we're diving into one of the most legendary and at times notorious strategies in all of finance, statistical arbitrage. It is an incredible story of quant genius, a system-wide meltdown, and an amazing comeback. Awesome! I can't wait to get into it.
All right, so let me see if I have the basic idea right. You're saying these quants figured out how to make money without having to guess if the S&P 500 was going to go up or down. I mean, that sounds a little like the Holy Grail.
You've hit the nail on the head. That's the whole beauty of being market neutral. See, the game isn't about predicting the whole market. It's about finding these tiny, temporary glitches in the matrix, pricing mistakes between stocks that should move together. And it all boils down to one really powerful idea from statistics. And that idea is called mean reversion. The best way to think about it is with this analogy of a dog on a leash. The stock's price is the dog. It can run ahead, it can lag behind, get distracted, but its true fundamental value is the owner holding that leash. And sooner or later, that leash is going to pull the dog right back. Stat Arb is just the science of betting on that pull. Got it. Okay. So you're betting the dog comes back. But how in the world do you know where the owner is supposed to be standing? The fair value of a stock isn't exactly written in the sky, right? It's always changing.
That is the million-dollar question. And that's where the real quant magic comes in. They build these sophisticated models to figure out a stock's expected price. And there are really two main ways they do it. One method is pure hardcore statistics called principal component analysis, or PCA. It just crunches the entire market's data to find these hidden statistical drivers. The other, more intuitive way, is to use sector ETFs. So for a tech stock, you'd use a big tech ETF as its owner or benchmark. The big difference? The ETF approach tends to lean towards bigger companies, while PCA doesn't care about size at all. It's totally unbiased.
So once you know where that owner is, that expected value, you need a trigger, right? You need something that flashes a big red light and says, bet now. That's where a tool called the S-score comes into play.
The score is basically our leash length meter. It tells us, in a very precise, statistical way, exactly how far the dog is strayed from its owner. If the score is 0, the dog is right where it should be, no trade. But if it's, say, -2, that means the stock is 2 standard deviations cheaper than the model says it should be. The leash is getting pretty stretched out.
And the quants, they're not just guessing. They set very specific tripwires. For instance, a fund might set up an alert that says, anytime a stock's S-score ticks below -1.25, boom, the system flags it as a high probability opportunity. That's the signal that the leash is about to snap back.
Okay, wait, I think the light bulb just went on. So the S-score hits -1.25, the computer automatically buys the stock that's gotten too cheap, but, and this is the key part, it simultaneously shorts the ETF or the factor to hedge out all the market risk. Then you just wait. The dog walks back to the owner, the S-score drifts back to 0, and you close out both sides of the trade for a tiny little profit. Is that it? You just do that over and over and these little tiny edges add up?
That is exactly it. You're not swinging for the fences. You're hitting thousands of tiny singles day in and day out. And for a long time, in its heyday, it worked like an absolute money printing machine. But the story doesn't end there. Just look at this. In its golden era, we're talking late 90s to about 2003, research shows that these PCA-based strategies delivered an average annual Sharpe ratio of 1.44. Whoa, back up. A Sharpe ratio over 1.4 from market-neutral strategy that's supposed to be low risk after all your trading costs? That's insane. That's the stuff of legends.
It really was. But, as you can probably guess, it couldn't last forever. In the very next period, from 2003 to 2007, that same strategy saw its Sharpe ratio collapse to just 0.90. The edge was disappearing fast.
So what happened? Well, one word, crowding. You can see it plain as day on this chart. Look at that blue line. It's the strategy's performance. Right around 2002, it just flattens out. The secret got out. Every quant fund, every investment bank, they all built their own version of the same machine. And when everyone is chasing the exact same tiny anomalies, those anomalies vanish.
Okay, right. Too many fishermen in the same small pond. But that makes me wonder, what happens when a strategy is that crowded, with everybody holding the same positions, and then a real crisis hits?
You get a stampede,
and there's only one tiny exit door. That's the absolute perfect way to describe what went down in August of 2007.
History now calls it the quant quake, and this chart just shows you how violent it was. That sudden, terrifying cliff dive in August 2007. The consensus is that one really large fund, for whatever reason, had to start liquidating its huge StatArb book, while their selling pushed prices even further away from the mean, which triggered automatic sell signals at all the other funds, which forced them to sell, which caused more losses. It was a death spiral. Everyone was leveraged to the hilt and sprinting for the same exit at the same time.
Man, what a nightmare. So that really is the multi-billion-dollar question for today, right? In 2026, is StatArb just a relic? Is it dead? Or did it just evolve?
Oh, it absolutely evolved. You're right that the simple first-generation version of StatArb was dead and buried after 2007. But quants do what quants do best. They went back to the drawing board, sifted through the data, and they found a new, smarter way to play the game.
And get this, the results were just staggering. Remember that decaying Sharpe of 0.9? Well, during that exact same 2003 to 2007 period, a new and improved ETF-based strategy was quietly crushing it, posting a Sharpe ratio of 1.51. It was even better than the original Golden Age strategy.
So what was the secret sauce? It was actually brilliantly simple. They started paying attention to trading volume. See, instead of treating every tick up or down the same, they started looking at price moves in what they called trading time. Put simply, they realized if a stock is tanking on massive, overwhelming volume, you probably shouldn't try to catch that falling knife. A high-volume move means there's real information, real conviction there, and it's super risky to bet against it.
And you can see the proof right here. That blue line, the new volume-aware strategy, it just sails through the 2007 quant quake pretty much unscathed. It's way more stable. Meanwhile, the old models without that volume filter just get annihilated. It was a game changer.
Wow. Okay, so if we're trying to pull it all together, it sounds like there are some huge lessons here for anyone trading today. Number one has to be watch for crowding. If you're hearing about a strategy on social media, the easy money is long gone.
100%.
The second lesson is you have to constantly innovate. For them, volume was the key. Today, it could be anything. Alternative data, machine learning. You can't stand still. And finally, don't put all your eggs in one basket. Don't rely on just one model, just PCA, or just one set of ETFs. The more diverse your factors are, the more robust you'll be.
But at the end of the day, it's so important to remember this quote from the guys who did the definitive post-mortem on the 2007 crisis. It's just a crucial reminder that no matter how sophisticated your math is, you can never, ever get arrogant. The market will always find a way to surprise you.
And this whole saga, the hidden statistical signals, the constant evolution, the search for an edge that no one else sees, it kind of makes you wonder, could these very same ideas be at the heart of the most successful and most secretive fund of all time, Renaissance Technologies? Maybe we'll tackle that next time on The Explainer.